I am super fired up that you're here today. Welcome. My name is Greg Cohen with JWB Real Estate Capital, and we have an awesome event here today. We do these Thursday live training webinars, and I have a lot of fun with them. I hope you do too. And some of the trainings are about how to be successful owning a rental property portfolio. It might be how to avoid maintenance costs. Some of these things that are lessons that are really going to help you build your portfolio. And some of these webinars that we do are going to be about properties, right? Because at the end of the day, you need to add a property to your portfolio if you want to take that positive step forward and build this wealth that will allow you to have the financial freedom that we want. So today is that opportunity for us to look at current available inventory here in Jacksonville. And if you are across the country or across the world, and you know anything about inventory here in the States now, it is tough to find cash flowing inventory. You talk to providers across the country in different markets and they ain't got it. They have to put you on waiting lists and things of that nature because they're having a tough time sourcing inventory. So inventory is scarce out there, especially inventory that is already rented, that is positively cash flowing and sets you up for long-term growth. That is really tough to find. We've got it. We're going to look at it today, and I am super fired up that you're with us today. So without further ado, I'm going to start sharing my screen, and hopefully my technology skills don't fail me here. And we'll turn on the slideshow. And Kate, if you'd give me the thumbs up to know that, oh, I got the thumbs up from Kate to know that my technology skills are on par here, right? I'm on my, I have brought my A game from a technology perspective. And so again here, hopefully you can see the screen here. We are looking at our current turnkey available inventory for JWB here in Jacksonville, Florida. A few housekeeping items to begin with. All of you have an opportunity to win this book here today for being on the webinar. This book, Rich Dad, Poor Dad, absolutely changed my life. I love to give this book away whenever I meet random people. I had somebody over my house helping me with landscaping the other day, and somehow the conversation turned to Rich Dad, Poor Dad, and I gave away the book. So the reason why I love giving this book away so much is because in a prior life, I thought corporate America was the route for me. I was very much of that mindset that most Americans are, where you're just going to put your head down and work for 30 years and work maybe in corporate America, but you're not really going to pay attention to the other avenues and the other things that you should be doing to increase your financial well-being. You're just going to work for 30 years and that things were going to work out okay. This book opened my eyes and changed my life. And so I love to give it away. And what I do for all of our live trainings is I give that away to the folks that are the most engaged in this presentation. So whether that is comments, questions, answers to questions that I pose to you. I'm looking for the most engagement. And the reason that I do that is because when you are the most engaged, you are going to take the most away from your experience here today. And I know all of our time is very busy. So I want you to get the most out of this, and I want to put this book in your hand, Rich Dad, Poor Dad. So to start it off, so you guys know how the chat feature works and how the questions work, if you would like to go ahead and get in the lead, post some comment. If you've read Rich Dad, Poor Dad, put something in the chat box or a question here, and just so we know that works. And throughout the webinar here, continue to do that. This is going to be interactive. I'm going to ask questions of you, and we're going to see who is the most engaged, and then we're going to send this copy of Rich Dad, Poor Dad to you by the end of the webinar. One quick note, you do need to be in attendance with us at the end of the webinar, so don't think about cutting class. We are watching. And so with that, let's jump right into it today. A little bit about me. For those of you who haven't had the pleasure of meeting yet, my name is Greg Cohen. I am one of the co-founders and the CEO of JWB Real Estate Capital. I personally own over 300 rental properties. I share that with you because I want you to know that I speak from experience, and I can help you out a lot. If you have built a large-scale portfolio, you know that, you make some mistakes along the way. And I am certainly of that same experience. Early on, I made some mistakes. Now owning over 300 properties, it's a well-oiled machine, and we've helped literally thousands of investors do the same. We do serve over 1,000 clients. They've purchased over 2,000 investment properties with JWB. We currently manage over 3,100 properties. We manage over $350 million in assets, and we have over 80 employees here at JWB. So I want to bring all that wealth and knowledge and experience right to this webinar, and hopefully right to you so it can help you benefit. Why should we be investing in Jacksonville? This is a great opportunity to hear from some of you. Why, and some of you who may be investing in Jacksonville already, why have you already invested in Jacksonville? Why do you choose Jacksonville maybe over another market out there? Maybe, why do you think another market is better than Jacksonville? Let's start the conversation here. So if you have some thoughts on why you should invest in Jacksonville, I'd love to hear from you. And Jonathan says appreciation and cash flow. He must have been studying a lot of the things that I teach about, because those are two great answers right there. We've got Carrie, who says continual growth, right? She's talking about the potential for long-term appreciation right there. John says assets put money in your pockets, liabilities take money out of your pockets. That is in reference to Rich Dad, Poor Dad. He has read that book. I love it. It teaches you how to actually analyze what's an asset and what's a liability. Frank says it's a growing city, so population growth is incredible. And population growth, of course, is a leading indicator of home price appreciation. John says no state income tax. Great example there. And Chad says a diverse employment base. Yeah, absolutely. We do have a diverse employment base. One of the things that can be a struggle for investors out there is they might find a market that they like, but that market just simply might only have one major employer. And so if you build a large scale portfolio, you're really beholden to what that employer does. Because at the end of the day, in order for this whole model to work, people have to have jobs. And if that employer and that one employer in that city would leave, you'd be in a tough spot. So Jacksonville is the opposite, right? Our largest employer is the military right now. We're shipping, logistics, healthcare, financial services. We have 3 Fortune 500 companies. So you guys are nailing it right here. All very good answers. One thing that I wanted to point out as to why investors are putting a lot of money in Jacksonville in relation to other markets is the potential for long-term growth. That's what stands out about Jacksonville. When it comes to positive cash flow, Jacksonville's numbers are similar to a lot of the other cash flow markets that you guys probably know of out there. But appreciation is the difference. And I wanted to walk you through a quick example before we look into the properties that illustrates how powerful this is. So 4.32%. What is that? Anybody want to take a guess? What do you think 4.32% is? Can we get some theme music, Kate? I try to put Kate on the spot as much as possible. I'm trying to get her on camera here too. We couldn't figure it out before this started. But Chad says average appreciation over the past 10 years. It's a very good guess. Not exactly right, but very, very close there, Chad. Carrie says interest income. Nope, not interest income. Jonathan said in Jacksonville housing, might be in reference to a quicker earlier thing. So John says last 10 years of average appreciation, very close. John says average annual appreciation rate in Jacksonville. Kevin says 5-year appreciation. Frank says historical appreciation. You guys are really very close, and some of you got it here. So 4.32%. What this number is the average annualized appreciation rate in Jacksonville. It's what we know to be the historical trend, okay? This data is pulled from the Federal Housing Finance Agency, and the time period that this looks at is very important. I want to teach you about this because this is information you can use to analyze any market out there, and you can get any of this information on any of that market right here at that down here at the Federal Housing Finance Agency website. I put the link there for you, but you can go there because I want to teach you how to analyze this stuff. So what you want to do is look for a very long time period, typically over 20 years, and you want to see what the historical appreciation rate has been. The reason why that is so important is because if you analyze real estate cycles, real estate in specific markets tends to repeat itself after a 10 or 20-year cycle. So average annualized appreciation rates tend to repeat themselves every 10 or 20 years. So if you go to the Federal Housing Finance Agency and you look over the last 20 plus years as to what the average annualized appreciation rate has been, then you have a very good indication of what the average annualized appreciation rate is going to be for the next 20 some odd years, right? And that's really powerful when you're building a rental property portfolio and you are planning on holding on for the long haul. I'm going to show you just how powerful in just a second. So again, to recap, 4.32% is the average annualized appreciation rate per year in Jacksonville. That does not mean that it appreciated 4.32% over 27 years total. It means that every year on average, it appreciated 4.32%. Okay? And again, that's over the last 27 years. If you're trying to learn how to do this for yourself and any other market out there, look for anything over 20 years. All right, so 4.32%. Is that a really good appreciation rate? Better believe it. It's a very good appreciation rate. Okay? Just how good is it? Well, home price appreciation per U.S. city, 1991 to 2018. Again, from the Federal Housing Finance Agency. I pulled some very common cash flow markets that we all know out there. Cleveland, Memphis, Birmingham, Kansas City, and Jacksonville. And these are what their historical appreciation rates are during that same time period. You can see Cleveland comes in well below, right? Memphis is a little bit higher, Birmingham, Kansas City, but all of them pale in comparison to Jacksonville. So let's take Cleveland, for example, a little bit under 2.5%. Jacksonville is about 4.3%. What does that really mean in terms of dollars in your pocket, right? This is what I want to get across, because when you're thinking about building your long-term portfolio, there's cash flow, which is what we require for this to be a positive investment for us, for something for us to consider. It has to pay for itself. And then there's the total return provided by your long-term appreciation, right? Which do you think is going to be more impactful after a 27-year hold? Well, we're going to find out here in just a second. Okay, so Cleveland is low. Population has actually decreased in Cleveland according to the U.S. Census. Okay, Jacksonville population has actually increased for that same time period. It grew 40%, and it's not surprising that appreciation rates have also been much higher than normal. Okay, but let's talk about this in terms of real dollars in your pocket here. If you purchased a property for $100,000 in Cleveland in 1991, your property with that a little bit under 2.5% appreciation, your property would be worth $188,000 today, in 2018. Pretty cool to earn $88,000 of long-term growth, of equity appreciation there, right? But if you purchase that same property for $100,000 in 1991 in Jacksonville, that property would be worth over $313,000. That is the difference. That what doesn't seem like a whole big difference, 2.5 or a little bit below to 4.3, doesn't seem like it's going to rock your world, right? But it will when you're talking about a 27-year hold for a $100,000 asset, right? That's a difference of just under $125,000 just by investing in a market that has proven to be a higher performer of long-term growth. This, in essence, is what is driving so many investment dollars to Jacksonville. And my question to you is, which would you prefer after 27 years? Because if you analyze Jacksonville with a market like Cleveland, Cleveland will bring in a little bit better rental income and cash-on-cash return. I'll be the first to admit that. It's a lower purchase price. Your rents are strong there. You're going to get a higher cash-on-cash return from rental income if you go to a market like Cleveland, right? But which would you rather have? Maybe an extra $25 a month for investing in the Midwest? $25 a month times 27 years. Sure, it's a nice number there. Or would you rather have an extra $125,000 in appreciation in Jacksonville? I guarantee you 25 times 27 years, $25 a month times 27 years, doesn't even compare. I think it's like 16 or 17 grand. If one of you want to check the math on it for me and try and put it in the chat box of what $25 a month over however many months that is for 27 years, I guarantee it's a lot less than 125,000. And in essence, that's why I put my money in Jacksonville, and that's why a lot of people are doing it as well. I know we've had a couple of questions and chats that have come in here, and if I haven't gotten to them, I want you all to know that we're going to make sure that we have time to go through those as best as we can throughout the presentation and at the end of the seminar. So don't you worry there. But let's get into the Jacksonville market. Okay, what I wanted to show you is our footprint. You can learn a lot by where people have actually put their own money, and that's what I wanted to show you. So I'm showing you a map of Jacksonville. All of these little blue pins, and I think they're blue. I always forget. I know I'm colorblind. Okay, I got the thumbs up that they're blue. There we go. Okay, so all these blue pins that you see over here, those are properties that JWB has purchased. Many of those properties our clients have purchased from us. Our 300 rental properties are in there as well. And to date, there's over 3,100 properties on this map, and we manage those properties. So this is where we put our money in the Jacksonville market for ourselves and for our clients. And what you'll see are there's 4 main areas, right? Now, Jacksonville is a huge area, it's a huge city. It's 3/4 the size of the state of Rhode Island is how big Jacksonville is. So largest city landmass-wise in the country. But there's only 4 neighborhoods that we put our money in, and those are these 4 neighborhoods with the circles that I'm showing you here. There is the north side up here. We've got Arlington right here. We've got the south side, and we've got the west side here. And those are the only 4 places. We've been doing this for 13 years now. We put all of our money there. We're going to continue to put all of our money there because those are the perfect cash flow sweet spots. And as I'm going through some of these properties that are currently available that you can purchase here, I want you to know that I only have time to go through 2 today. I'm going to choose one in the Arlington area and one on the west side. That has no significance between which areas I like the most. I like them all the most. These are the 4 areas that hit our criteria. I just happen to choose 2. So I don't want you to feel like Arlington and the west side are any better than the north side or the south side. It just happens to be the 2 that I chose today. And I do see that we have a bunch of chats here. So let's see. And we've got some questions. And we've got Carrie says, wow, look at all those blue dots in the 4 neighborhoods. Yeah, it's pretty cool, right? I always think about this as a little bit like that game of Risk, right? When you're trying to take over like whole countries. I always thought of that as we were putting these maps together. And it really helps clients know that this isn't a one-time thing they're investing in with us. It's doing the same thing over and over again. That's what we do. And we've got a number of questions here. I see one of the questions. Steelers will not make the playoffs this year. Jonathan, all right, my friend. I was in a happy place until you started talking trash on the Steelers. The Steelers do come up in pretty much every webinar that I host, so I'm glad for that segue there. Jonathan, if I remember correct, is from Cleveland, and he knows that I always bring up Cleveland when we're talking about the difference in markets. So I wanted to make sure that he knew that I brought up Cleveland for a reason and that the Browns are not going to win the division this year. We've got a couple other questions here. Can I do this in Atlanta? Any benefit in landlord paying utilities as part of the monthly rent for tax deductions and interest rates and closing costs average for turnkey property? Those are 3 great questions. I'm going to save those for a little bit later and make sure we get to those. But thank you, Jonathan, and thank you, David, for chiming in there. And Kate, if you wouldn't mind, help me remember to not forget those by the end, okay? Because I definitely don't want to leave you guys hanging. All right, cool. So we've got these 4 neighborhoods in Jacksonville, and let's take a look at the one property that I'm going to show you here in the Arlington area. Brand new construction is what JWB is all about. You look at that home right there, I can guarantee you the homes that I rented when I was growing up looked nothing as nice as that. And so what we're able to create is a great experience for a resident to rent this home in order to stay with you for a long time, meaning to be your tenant for a long time, to pay rent consistently. And it's really easy to do that when you have such quality, brand new construction. They get to move in they're the very first person moving in, which is not normal. So that's one of the keys that we absolutely focus on. Within that map here, this is where Arlington is. It's this where this oval is here. And I wanted to go a little bit deeper into Arlington because it's a pretty cool story here. So Cocoa Avenue is this I think it's red, this red oval here. And so that's the street that the actual property is on. Take a look at all of the blue dots as we zoom in, right? There's well over 125 properties that JWB has either built or is currently managing in that area. But there's also a section here, if you guys haven't picked up, look at all those blue dots. Like, I'd have to zoom in like 3 more times in order to space those things out. There's about 60 dots that were there. Now, how do you guys think that we could have gotten 60 dots that we manage up and down the row there? Anybody want to take a guess as to how JWB could have done that? All right, we've got a little bit of chat coming in here. We built them, right? John said we built them, and he's absolutely right. But, John, if one, and and we purchased the lots years ago. Kevin said you developed the land, you bought and developed the land from Frank. All you guys are nailing it here. So for any of you that have heard about this phenomenon called built to rent, right? That's what JWB does. We build these homes out, we rent them as passive income streams for clients like you guys, right? Well, this was never done prior to 2011. JWB actually was the first turnkey provider to realize this, that there was an opportunity to build new construction and to create these income streams. And over 470 properties later that our clients have purchased from new construction from us, we see how successful it is. And you see all the other big guys, you see the hedge funds now jumping into build to rent. Well, we've been doing this since 2011. Actually, in 2013, the Wall Street Journal picked this up. And they featured our company on the front page of the Wall Street Journal because we were the beginnings of this national trend of build to rent. And it all happened. Oh, let me make sure I get right back here. Tech skills don't fail me now. It all happened right here and that little spot right there. Those 60 homes or so were the genesis of build to rent, which is now this national phenomenon. Pretty cool, huh? So, all right, so here's the numbers on Cocoa Avenue. So you can see here, I'll point out a couple of things. It's a $170,000 purchase price, but let's go down to 2 years on this lease at $1,275 rent. When it says lease dash 2 years, that means that we already have the resident in place. That means that if you purchase this home, this is positively cash flowing from day one. So to put this in perspective, because there's an inventory shortage out there, most people have to go on a waiting list, which means that you choose a provider that you like. It probably took you maybe, I don't know, a bunch of time and phone calls to find one that you like. You finally get to that point, you got to put some money down with that provider. And you know what they say? You got to wait. You got to wait for us to find you a property. You got to wait for us to build you a property, right? It might take 6 months for you to actually get an actual property. And then, oh, by the way, we still got to rent it out after that point, right? So there's the timeline for most people out there, because of the state of the market, is you might have to wait 6 months, maybe to a year, to actually receive positive cash flow. Not the case with JWB. We do this all in the background, right? And we're able to present these types of opportunities on a silver platter. And that's what you get here. So this resident's already signed up for a 2-year lease at $1,275 rent, which is absolutely fantastic. There are rent escalators that we actually put into leases as well. So the second year, the rent's going to be more, which is going to increase your cash flow. And we sign only 2- and 3-year leases. We don't sign 1-year leases because it's crucial for your long-term returns. So pretty cool here. A very typical normal investment property for JWB. You'll see here that, oh, I also wanted to point out homeowners insurance. About $400 for homeowners insurance for the year. Way low. People always ask us, is that real? Is that really going to cover insurance? And it absolutely is. When you build new construction, the codes that are there today versus what they were in 1950 when other homes were built are so much stronger that the insurance companies understand that their risk is less. And so they charge you lower premiums. So $400 or give or take a little bit on insurance costs, that's already been quoted for the person who purchases this. And so you just simply have to accept that quote. So what you see here is your total monthly cash flow, about $200 a month, estimated total return on investment, 8.58%. That takes into account everything not named home price appreciation. So if you go back to the original part of this, webinar that we were talking about, I talked about the value of home price appreciation and why it differentiates us for other markets. These returns that I'm putting in front of you do not take that into account. And that's for a reason, because I want you to think of that as a nice bonus on top. 27 years later, after owning the portfolio, you're going to have a nice bump from appreciation. All right. And with that, I'll kind of open it up a little bit to some questions, maybe specifically about this properties. And Chad's got a great question here. He said, is this based off, what type of financing is this based off? This is based off conventional financing with 25% down. Very good question there. All right, we've got some other questions that we'll see how related they are here to this specific property. How much do you plan to increase rent yearly? So great question there. I kind of brought that up a little bit, but let me share what our plan is or what we implement. So the last year of a lease, we raise the rent $50. So we only sign 2- and 3-year leases. So if they sign a 2-year lease, we raise the rent $50 in the second year. If they sign a 3-year lease, we agree to keep the rent consistent for the first 2 years, but we get that rent escalation the 3rd year. So it's the best of all worlds. The single most important thing, even more important than rent increases, is duration of tenant stay. You've got to keep your tenant in there. So the fact that we can get long-term leases and also get rent escalations is a very, very powerful thing for our clients out there. And it's one of the things that sets us apart for sure. Any concern with flood zones? Another great question, Jonathan. So flood zones, let's go back actually to where are we here? Okay, right here. So, Jacksonville is on a beach, right? We are on the water. This, of course, is not the beach here. This is a river, right? But you will not see any of our neighborhoods very similar or very close to a beach. Reason is because cash flows don't come when you're at properties by the beach because the prices are too high and the rental demand is not high enough, right? So when you're talking about flooding, you're talking about properties that are, on the water or very close to the water. We don't have those. So the short answer is that the vast majority of our properties are not in flood zones. We do not have concerns with flooding there. The next property is something else to take a look at. 7808 Playschool Lane on the west side. And this is what Playschool looks like. So for looking at the picture here, what do you notice is different about Playschool versus what you just saw on the property on Cocoa? All right. Man, Kate, I'm telling you what, you are going to have a really tough job choosing who has been the most vocal here. Because we have, I think, tons and tons of notes coming in here, and you guys are nailing it here. We've got, let me see here to make sure to say thank you to John. John says townhome. Chad says townhome. John says townhome. Carrie says tall and narrow. Frank says multifamily. Another townhome from Kevin. You guys, thank you very much for your engagement. I hope you guys are getting as much out of this too. So it's a townhome here. And John has a question about condo fees on the unit. We are going to talk right about that in just a second here. But a townhome is a wonderful investment. It's a large percentage of what we do here at JWB. We've been building townhomes, either the townhome communities that we build or townhomes, that we didn't actually build the entire community. Still can be great investments. Because what townhomes allow you to do is to get brand new construction, and it allows you to have an investment that typically is going to cost less. So that's why people typically go to townhomes versus single family homes. It's typically a budget item, and you can buy more properties when you buy things that cost less. Now, the cool thing is that whether you're talking about a townhome or a traditional single family detached home, the returns on investment, as I'm going to show you here, are very similar. And to answer the question about townhome HOAs, that does take that into account. And we're going to take a look at that. But this is on the west side here. So that's that area right here. Playschool. So purchase price, first thing to point out, $155,000. I typically share with people that our typical purchase prices are between $160,000 and $200,000. So this is definitely on the low end of what you'll find. Which is great opportunity there. 3 beds, 2.5 baths, a 1-car garage. Very cool again. I happen to choose 2 properties that I looked at, and they both, when I was preparing for this, and they both happened to be leased for 2 years. And that is not normal. That's not always the case. It does happen from time to time, but it's certainly not normal across the landscape of turnkey providers. So again, you could walk in here owning this asset and having it be cash flow, positively cash flowing from day one. 2 years of a lease, resident already in place at a $1,275 rent number with rent escalations. So the next thing, a great question there, does it include HOA dues? And it does. Okay, it does include those HOA dues. This is something we care a tremendous amount about. In fact, we've built out this entire Playschool road here of townhomes. We have a significant influence on how decisions are made within the townhome HOA between us and the clients that own these assets. We have a lot of votes when it comes to budgets for HOA. So it's not the same type of risk that you face with a crazy HOA president coming in there and jacking up your HOA dues. We take a lot of time and concern before putting an asset in front of you to know that we do have a significant influence. And right now, that the HOA fees are what they are, $13.95, which works great for cash flows. And as I mentioned, significant influence going forward on what that budget would be. So what all of that comes down to is an estimated monthly cash flow of about $200 a month and an estimated total return on investment about 8.9%. Again, very similar to what you see for a single family detached house. I know we have some more questions here, so let's see if they're specifically property related here to this one. And we've got, do you get a discount on homeowners insurance through your partners and providers? Absolutely. We have an insurance teammate, actually literally about 15 feet away from me, who rents space in our office complex here at JWB because she is so in tune with all of our inventory. She's able to, first of all, she was able to get insurance quotes on this before we started building it. We knew what it was going to be. And certainly before we would bring it to you as a client to be able to purchase it, the insurance number has already been determined and it's been quoted and priced out amongst her providers to make sure that we get the lowest rate. At the end of the day, I mean, we get no referral fee or anything from getting you low insurance rates. Our job is to produce a high rate of return for you. So we get super excited. The lowest we can go on the lowest we can go on insurance rates or interest rates for your loan or things of that nature. So yeah, you can have a lot of confidence. It's a really low homeowners insurance number. Chad says, are all the townhome rentals, or are they mixed with owner occupants? These are rental properties. So the townhomes that I'm showing you on Playschool Ln are rental properties. There are a lot of owner occupants around the area as well. This is not a rental area. It's not 100 homes together that are going to be rental properties. This is a street of townhomes, and it's surrounded by single family homes around that street as well, many of which are owner occupants. But a very good question there. What he's really referencing is when you're buying new construction, a lot of the build to rent outfits right now, they can't purchase one lot here, 2 lots there, or 3 lots there. So what they do is they buy a whole strip of land and put 100 houses on it that are all single family and all rental properties. And the jury is still out as to how beneficial that is versus the risk of it being a rental neighborhood, a rental subdivision. But that's not what you're going to find here. Carrie says, how does it work after a 2-year lease is up and the tenant doesn't want to sign longer? Who finds a new tenant and how much notice do we have? I'm going to save that question because I'm going to focus on the ones that are a little bit more property specific, but thank you, and I'll certainly get to it. John says, insurance rates, deductible amount. So on your insurance, you know what? I'm not going to be the expert on the insurance, so I'm going to defer a little bit. That is a great question to jump on the phone with my team, and I know I can get an answer for you, but I'm not an expert. And when I'm not an expert on something, I'm gonna defer. So I think a great thing, John, to reach out to our team. You can go to chatwithjwb.com or call our office, and we'll absolutely get you that information there. Chad, any value adds included with HOA dues, such as trash, cable, pool, TV? A great question. The answer is no. I think landscaping is included for the community, but other than that stuff, no. And you want it that way. And the reason is because the way that we can make the numbers work on this is we don't want these townhome communities with gates and pools and all this extracurricular activity, because it's not going to help you deliver a return on your investment, and it's going to increase your HOA dues, and that is going to drop your cash on cash returns. It's going to drop your cash flow. So it's strategic that we don't want that. And you don't need it for this type of a community. We're going to rent your unit for you just fine without pools and cable TV being included and all that good stuff. So a very good question there. We've got a couple of other questions here. Let's see here. I think those are all. We've got a number that we're going to save here for the end. I think we've got about 10 minutes here. So we'll certainly get to your questions here. And if you have additional questions, now would be a great time to fire those in to make sure that we can plan accordingly and do as much. Kate, did I forget anything before we jump right over to questions? Have you been keeping track of the 472 different comments and questions and answers that we've gotten?
I can only do it when you throw the name out.
I know. So that's kind of what I'm trying to do too. So Kate can't see all the questions and whatnot. She's going off of me just, talking. so I'm making sure I can give credit where credit is due. We are going to go down the line with questions here, and we've got about 5 minutes here. So again, if I can't get to any of these questions, I do want to be respectful of everyone's time. You go to chatwithjwb.com, set up a time. Of course, we're going to be able to answer your questions there. And you can also give our office a call, 904-677-6777. You can go to info@jwbcompanies.com. You can email us there, info@jwbcompanies. We're going to get your questions answered, even if I don't have it in the next 5 minutes. Let's see here. Jonathan asked, interest rates and closing costs average for a turnkey property. Man, I didn't check what the most recent rates are on our turnkey evaluations. Do you happen to know, Kate? I know I'm putting you right on the spot.
Repeat the question.
The interest rates that we're quoting on our property evaluations?
Oh goodness, they're low.
They are low.
They're very low.
So we get these quoted. We have our lenders, obviously, we're in unison with them. So we know if there are interest rate changes. We always quote the most recent change. Don't quote me on this. I think we're representing a 5% figure for interest rates at the moment. So yeah, so that's what this is assuming. Closing costs, about 2.5% of the purchase price is what we expect for closing costs. That's a standard across the board that we've seen from the thousands of properties that we've sold. 5% interest rates, 2.5% of the purchase price for closing costs. Jonathan had a really terrible comment there, something about the Steelers that we're going to just brush over there. And then Jonathan also asked, any benefit in landlord paying utilities as part of the monthly rent for tax deductions? Benefit in landlord paying utilities as part of monthly rent for tax deductions. No, there's no benefit in the landlord paying the utilities for tax deductions. You are not, you know what? I'm going to get back to you on that, Jonathan. If I don't know the answer 100%, I'm going to say no. I'm pretty sure there's not a benefit, but I don't think I've ever actually asked that question. So I'm going to get back to you on that one. I don't think so. I mean, you're able to write off everything that you spend. So maybe, I don't know. I'm going to get back to you on that one. So then we talked about flood zones. Kevin says, how much do you plan to increase rent yearly? We talked about that one actually. So again, our rent escalations in the last year of the lease, we increased $50 to get rent escalations. How often do tenants stay past their initial lease? So the data on that is pretty significant. We have, what we do is we track the average duration of their initial lease. We track the percentage of tenants that renew, and then we track the average duration of tenant stay. So the average duration of lease, meaning when they sign that first lease, it's 27 months. So between a 2 and a 3 year lease, average is 27. 70% of our residents renew when it comes time for that renewal, which is a huge number. And then the average duration of tenant stay is 49 months. So over 4 years. Average home warranty on new construction homes. It's a 1-year warranty with the builder is your typical warranty on new construction homes. How are maintenance costs handled? Another question from Jonathan. I think Jonathan's had like 4 really great questions, just a note there. So, but he is from Cleveland. So
And this is the guy that's
second note.
not with the Steelers. Right?
Second note, he is from Cleveland. How maintenance costs handled. So when you invest with JWB, we are a true turnkey provider. Everything is handled by us. You're able to invest in rental properties almost like you're able to invest in a mutual fund, right? Or a share of stock, where for JWB, you're going to put your money in to buy the house. Everything else when it comes to the resident is handled for you, and we send you the rental income every month at the end of every month. We want you to think of this almost like a dividend check. So if there is a maintenance item, we're on top of it. We have thresholds where you give us the authority to act on your behalf up to a certain threshold. If that's within that threshold, it's a really small thing. We got to change a lock on a door or something. We're not going to call you about it. We're going to get it handled, and then we're going to make you aware of it after the fact. If it's a bigger item that has to come up, we're going to get the solution in place. We're going to have a solution in place. We're going to give you a call and say, here's what we recommend. Here's what's going to cost. Can we get your approval? But at the end of the day, this is all handled for you. Chad says, does the property management fee drop after a certain number of homes are managed? It is a certain number of homes that are purchased is how you can drop your property management fees with JWB. It's part of our elite program. If you're in the JWB elite program, once you get to your 5th property purchase, we drop your monthly property management fees from 10% down to 9%. when you get to 10 homes under that you purchased with JWB, we drop you again from 9% down to 8%. So big savings there. Kevin asked, do lenders require 25% down? And the answer is no. You can go lower, and some of our clients do. And that's a great question, more of the planning conversation for you and our team. That's really what we use for our strategy sessions. Even before we pull the trigger on this house with you, or we're going to make sure we know what the plan is in place. And a lot of that is, okay, what are my financing? What's the capital that I have to work with? And sometimes 20% down does make a lot of sense for folks. We just try to standardize it. And so that's why we choose 25% for that answer there. All right, we've got a few other chats here. And I know we are just about out of time. So I'm probably going to cap it at the ones that are in here. And for any of those other ones, please feel free to send them in. But I will probably not be able to get to them here today. So what I'm going to do is encourage the handful of questions we weren't able to get to go and schedule your time to chat with us. Chat with jwb.com.